Teşekkürler Özlem. Juan Carlos Rudado from NATIXIS Securities. Juan Carlos NATIXIS Securities'den bizimle birlikte. Now let's start with the change in the non-farm payrolls. It came much better than expected. It's a surprise. 226,000 was expected. What did we get? 280,000. So it's a strong jobs report. The markets are in the red. Does it imply that we are in a good shape right now?
Yes, absolutely. The main thing here today is that the number is way beyond expectations. 280, the market was expecting 226.
But the unemployment is down 0.5, up, sorry. It was 5.4, now it's 5.5.
Absolutely. But this is due to the fact that labor participation rate increased. So that's not pretty a bad figure given the fact that labor participation rate increased. So the main point here is more the job creation, which has been extremely important, and that's the figure that the markets are focusing on. The fact that if we have 280 and several months of consecutive numbers above 200 are going to probably push the Fed to increase rates in September and no longer in 2016 as one part of the market was expecting it.
So June is off the table, autumn is in the move. But how about the wage inflation? That was also great, right? Because we got 0.3 instead of 0.2 on a monthly basis, 2.3 as opposed to 2.2% on a yearly basis. It's not a big actual increase, but can we say that the wage inflation is on the rise, just like Yellen wanted it?
Absolutely, and that's another figure that is pointing towards this rate hike in September. Remember that we need two things. We need a little bit more of inflation. This is coming. We're having wage inflation. We're also having a little bit more of higher oil prices. This we're seeing also in inflation expectations. That's also why the long-term interest rates in the US, the 10-year bond, is increasing. So we're having clearly a cocktail in order to increase rates in September. On one side, we have a little bit more of wage inflation, 0.3% on a month-on-month figure, and a stronger employment report.
So, as you said, the treasuries are flying right now and the stock market is in the red, right?
Yes.
Are we going to keep seeing this?
Absolutely. As soon as we're going to enter to this period of tightening in terms of monetary policy, we're clearly going to see a little bit more of market volatility. Long-term rates are going to continue to increase. I think that's the tendency that we need to bear in our scenarios. On the structural level, long-term yields are going to increase. That said, we're going to have volatility, which means they are going to come down, they're going to increase, but the tendency is there. The Fed is going to hike interest rates in the second half, September or December. This report is pledging towards September, but this is going to come.
Okay, Juan Carlos, I understand. So that means that American economy is healthier than the GDP implied. You're an expert for the emerging markets too. I know you analyze the US economy. So US economy looks healthier looking at today's data. But how is this gonna impact the emerging markets, which is your specialty?
Well, that's very bad for emerging markets. Very, very bad. If you see, for example, how currencies are reacting today,
yes,
everything it's weakening against the dollar. Why? Because we're going to focus on the interest rate differential, the gap between the long-term year bond in the US and the refinancing cost in emerging markets. And this gap is going to narrow, which means that people is going to put money into the US market, people is going to buy US treasuries, and they are going to take out the capital from emerging markets. So this is particularly bad for those countries who have poor fundamentals.
Like which countries?
Well, I have a very long list.
Okay.
And among my countries, I am targeting two specificities.
Yes, please.
The two specificities are, first of all, a large current account deficit.
Large account deficit.
Yes.
Okay.
And here we have a broad base of countries, Turkey, Brazil, Colombia, and you can continue on into the spectrum of emerging markets. The second element that I'm pointing out in my scenario, it's the share of portfolio investment in the financing of this current account deficit, which means if you have a lot of portfolio investment, so short-term capital, you're going to have tons of volatility. If you're financing this current account deficit with short-term capital flows, people are going to take this money, so it's an important vulnerability. So this means that countries like Turkey are going to have a lot of volatility, Brazil, Mexico, which is a country that has been solid. You can see the currency, it is weakening, the bond markets are weakening due to the fact that there's a strong share of portfolio investment. So even the solid countries are going to suffer.
So one, current account deficit. Can you repeat again?
Current account deficit and portfolio investment.
Portfolio investment.
The strong share of portfolio investment in the financing of the current account deficit.
So where should we invest in?
Well, clearly this is a period of strong dollar. You can see it, for example, the tendency of strong dollar appreciation. We have seen over the past year with the dollar weakening, strongly appreciating over the past couple of months. We had a relatively quiet period between March and June where the dollar was weakening again, but at the end the tendency is there. The dollar is going to continue to appreciate. This is clearly a momentum for long-term rates, for more increase in terms of long-term year bonds in the US, and probably you're going to see some equity markets that also are going to be in good shape after this volatility in emerging markets.
Okay, now from Turkey we're going to move to Greece. The US market is concerned about what's going on with Greece. Yesterday, they delayed the payments to the end of June so they can make a whole lump sum payment. Do you believe they're going to be able to make that payment and the impact on us here?
Well, for me, it's incredible, this situation. Like, you want to say that they should make the payment, but at the same time, it's clearly on their interest to negotiate and have the best conditions in order to have less austerity and in a certain way do their political left-wing campaign and program and so on. The thing is that on the other side you have the Troika, which is Brussels, IMF and so on, that need efforts, that want efforts. So we have this struggle between these two forces that is going to continue. At the end, everyone knows that they are going to pay. They are going to try to win a little bit more of time, but they are really trying to win in terms of power of negotiation. That's why they delay the payment, and that's why we're going to probably see the payment by the end of the month and not at the start of the month.
Are we really going to see that payment? That's my million-dollar question.
Well, I think that it's under interest, because imagine what happens if they don't pay. The consequences for the Greek economy are very serious.
And everyone is trying to gauge or measure the impact of Greece in the US market. I mean, how big is that really? I mean, it's obvious that there's a contagion effect in Europe, but how about the US?
In the US, the impact is not that big because, as you know, the financial links are relatively small. The other thing that we need to take into account is that who is financing Greece today? And basically it's the ECB, it's basically the IMF, and it's not the United States. So besides one or two hedge funds, well, a couple of hedge funds that are buying bonds, the impact is very small.
Well, thank you so much for coming.
You're welcome.
We're going to have you again, and thanks for your valuable comments. Sohbetimiz burada sona erdi Özlem. Görüşmek üzere pazartesi tekrar iyi hafta sonları.